Hi, this is Editor's Take. I'm Sakshi Batra, and with me is Gaurav Chaudhary. He's the Deputy Executive Editor of Moneycontrol, and we are going to be discussing about the RBI's policy, which actually made a cut of 25 basis points yesterday, and how is it really going to impact your loans and EMIs. Thanks a lot, Gaurav, for joining in. Now, first of all, I want to understand from you, like after yesterday's move, we've already seen the this rate cut, repo rate being slashed by 75 basis points in the 3 consecutive policies. So far, have we really witnessed any slash in the EMIs?
Yeah, so there's something called the monetary transmission, and the RBI Governor Shaktikanta Das yesterday was very clear that the central bank is monitoring the level of monetary transmission. Effectively, it means that the extent to which banks are lowering EMIs based on repo rate cuts. Repo rate, as we know, is the rate at which banks borrow from the RBI. And so logically, it should always mean that each time the repo rate comes down, the EMIs or the loan rates that banks charge from customers should also come down by an identical extent. That, however, is not happening. Say, for instance, between February and April, the repo rate has been cut by 50 basis points. However, the weighted average loan rate that banks have reduced has come down, have come down by only 21 basis points. So the RBI governor is saying that there is enough scope for monetary transmission. That is, the banks have not passed on to the
Correct.
final customers the full extent of the repo rate cut.
Sure.
And there is enough scope, so the RBI is monitoring that. I think customers will have to wait, because banks have their own side of story to say that each time a repo rate is cut, it doesn't mean that the bank's cost of borrowing comes down by an identical amount.
Okay.
And they have their side of story, which also probably they believe is stopping them from passing on the full extent of a repo rate cut.
Absolutely. Now, the financial sector is also reeling under the liquidity crisis, which has stepped in from the NBFC crisis that we are seeing. Do you think that could be preventing or restricting the banks at least to pass on these kind of rate cuts?
No, not to the extent that it should have. But what has happened here probably is that banks say, if you go by the argument that the banks put out on this particular aspect, is that a repo rate is not the only source of funds for them. Say,
Sure.
for instance, they borrow people from, they borrow money from customers, in the
Yeah.
sense that every time we go and deposit money in the form of fixed deposits or savings deposit or any other instruments, it's the banks who are borrowing from us. So we are giving the money, and interest rates that we earn on our fixed deposits, actually the interest rates that the banks pay. So that's a cost for the bank. So
Yes.
banks are raising money from through deposits from
True.
people like us, from customers, from individuals, as well as from bulk depositors like corporates. So each time they pay an interest rate, that is a cost that the bank is bearing. It's not just always the repo rate, that repo window through which banks are borrowing from or raising money to pass it on to final borrowers as a lending instrument. So the banks say that if the repo rate comes down, it doesn't mean that the entire cost of borrowing or entire cost of raising funds for banks have come down.
Okay.
They have multiple sources of raising funds. Fixed deposits is one of them. Other forms of bank deposits are other, and they're paying money. That is, they're paying interest rates to all classes of depositors on this. So even if the repo rate would have come down, the fixed deposits, the interest rates on which their interest that they're paying to customers on fixed deposits are fixed.
Right.
So that is not going to come down. Only fixed deposit rates are going to come down for new customers.
Okay.
So what happens to the existing level of borrowing that banks have done, or raising of funds that the banks have done through fixed deposits? So that interest rate hasn't come down. So that that cost remains fixed for banks. So the banks say that repo rate will bring down their cost of borrowing, but reducing EMIs, reducing interest rates for final customers by an identical extent is never going to be possible.
Right. But this time around, we've also seen the RBI actually change the stance from neutral to accommodative.
Yes.
Do you think that will at least increase the liquidity situation in the financial system, and that could at least prompt the banks to cut the MCLR rate now?
Yeah, so MCLR, we have moved from the base rate to the MCLR system. MCLR system is that it's an incremental cost. So the system enforces banks to reduce or change their interest rate based on the incremental cost of raising funds. Incremental is the additional cost. So if the repo rate has come down, that is their incremental cost of borrowing through the repo window has come down. So in EMI or interest rates that they charge from customers have to come down by an identical increment. The fact that the RBI has changed the stance from neutral to accommodative does send out a signal to the banks that the RBI is going to cut rates even more.
Yeah.
And a rate hike is off the table. So banks will feel more comfortable in reducing rates. But we need to sound a caveat here that each time any bank cuts rates based on a repo rate cut, the FD rates will also reduce. The fixed deposit. So the customers, while gaining through an EMI cut, an existing home loan borrower might see his or her EMIs come down. But if she has fixed deposits in the same bank, and if she intends to, park money in a fixed deposit, the new fixed deposit rates will be lower than what she would have probably been getting in her existing fixed deposit. So it's a double-edged sword so far as customers are concerned. They might gain through lower EMIs, but they might end up losing they might earn lower interest rates on new fixed deposits than they may wish to do in banks.
All right, but in case the banks actually go ahead and cut the MCLR rates, then which of the consumers will be beneficial, or the borrowers? Will it be the auto loans, home loans, personal loans? Which will be?
So the home loans will be the biggest beneficiaries.
Yeah.
Auto loans are fixed.
Okay.
Most of the auto loans are fixed on fixed rates. So auto loans don't change. Depending, they don't move. They're not influenced by the repo rate cut to the extent the home loans are. But home loans are fixed to the bank's cost of borrowing, and these are floating rates. Most of the home loans are on floating rates.
Right.
So each time loan rates come down, the repo rate comes down, whatever the extent, the banks generally have to cut, are seen to be cutting home loan rates. So the home loan borrowers will be the biggest beneficiaries of any passing off on the MCLR rate cut or the repo rate cut through a cut in MCLR rates for banks. Corporate loans, bulk depositors can negotiate lower rates. But automobile loans and personal loans are fixed loans. If you have a car loan, it's unlikely that your EMIs will come down. Likewise, if you have a personal loan, it's unlikely that your loan rates will come down because the repo rate has come down, because car loans as well as personal loans are mostly fixed rates.
Right. Thanks a lot then, Gaurav, for sharing all that insight. So it's good news only for the home buyers, and they also will have to really wait for their reset cycle to start before their EMIs get reduced only after the banks cut the MCLR rates. So not so good news for the existing borrowers of the auto loans and as well as the personal loans as well, because your loans will be fixed. So even though it is good news that the overall repo rate has been reduced by the RBI, only home borrowers or home loan borrowers will be really beneficial if you're already existing loan borrower for your homes. Thanks a lot for joining us in this edition of Editor's Take, and do stay logged on to moneycontrol.com for more news and updates.